Hello, mic test. Can you hear me? Hello, classmates. Can you hear me?
Yes, Julie.
Yes, we can hear
you.
you,
Yes, we
Julie.
can hear you.
Yes, I
Okay,
can hear
thank
you.
you. Maybe it's professor's problem.
Anybody, you can, if you can mute, unmute, and then talk to me if you are hearing me.
Yes, we hear you, Professor. Can you hear us?
Professor, can you hear us?
Oh yeah, okay, yeah. All right, I see. Okay, say something now. One person can say something.
Professor, can you hear us?
Yeah, I can hear now. Thank you.
That's good.
1 minute. Yeah, I can hear now loud and clear. Are there issues we should talk about and questions we should talk about before we proceed? Are there issues we should talk about? Go ahead.
Okay, Professor, it has to do with the previous assignment. I was not available, and where I went to trying to connect, I was having a lot of internet um, challenge, and as such, I couldn't join the discussion class, and I'm finding a little bit difficult the assignment given, and I didn't know how to go about it.
Okay, for the previous assignment, I will check the module because at times when we put the due date, probably it will not allow you to submit the assignment again. I will open it because it's not your fault. Anybody would ignore a submit assignments. I think I'll open all those, I enable all those assignments, extend the due date so that you see if you can turn in those assignments. I will do that at the end of this class today. As soon as we finish this class, I will make sure I go straight to the module and update it. And then if you cannot turn in the assignment, in fact, either way, let me know. If you can turn in the assignment after I've done the enabling and extended the due date, please let me know also. If you cannot, yes, definitely let me know.
Okay, thank you, Professor. Does it include the quiz?
The quiz, did you take the quiz?
Yes, I was actually not available there.
You did not take the quiz, right?
Yes.
Okay, I will extend the quiz as well. I will open up the quiz so that you take it. Anybody who did not take it can go ahead and take it. If you have taken it, you don't need to take it again because it will not be possible. It's only one attempt.
Okay, thank you.
Okay, let me just note those things now. Assignment extend due date. Assignments. Okay, then quiz 1. Yes. Any other question? I've taken the 2 items here, assignments and quizzes, and quiz number 1. So I've taken care of that. I will go to the module and extend the due dates so that you'll be able to do the assignments. and quiz and take the quiz. Yeah. Any other question before
Professor?
we start? Yes.
For the assignment one and assignment 2, previously the model has issued, right? So most of us submitted through email. So do we need to submit again through model, or you'll be evaluating through the email?
Just for me, just like I'm making your life a bit easier for you, it also make my life easier for me. Because if you submit through email, what I would do, I have to download it and then upload it to the module, then grade it, and then post the grade. So it takes me a lot of steps. So that if you can go to module, upload it there, it will be easier for me to grade the assignment.
Okay, perhaps you can open back the links for us to submit back the assignment 1 and assignment 2 through model.
Yeah, I will check. Yeah, I think I had a link that I provided. If that link has expired, I will update it as well.
Okay, thank you so much.
Okay.
Professor, so
Yes.
on assignment 1, there was a problem for uploading. It only allowed other PDFs and document files. It didn't allow Excel file. So can you please make sure that it allows us to upload Excel file too for the assignment 1 only?
I think somebody raised that issue, and I think I will cross-check, but it's very likely what I did, I enable all type of assignment to be turned in.
Like, Professor, like.
So you have to, what you do is just go, if it don't work out, just send me a WhatsApp that, oh, I tried to upload it again, it don't work out. But it seems I went and changed those format, and instead of that, I updated with all type of documents.
Yes, Professor, but the thing is indicating, like on my own case, is indicating that we cannot submit on based on 2007 Excel. So that is one that's rejecting. I don't know whether you upgrade it based on the current Excel format.
No, I will enable all type of document to be turned in. Okay. That's what I think I did. I don't know, but I will check. So I'm not 100% sure. So as soon as I checked, if it is not done, I will enable it. If it is done, then go ahead and turn in your assignment.
All right, thank you.
Okay, let me just note it so that I don't forget.
Professor.
Yes.
Please, I have a question. Actually, it was planned that we will have quiz 2 after taking chapter 7, which we will discuss today. But will it be in the next week or the after next? And actually, me and some colleagues here are having holidays the next Sunday and Monday, so it will be hard to finish our quiz by then if it is uploaded next week. And so can we reschedule it for the next week, or it will be early this week so we can attempt before its deadline?
I don't understand the question. You mean the quiz? You mean the quiz to take the quiz number 2?
Yes, actually, last time it was scheduled after discussing chapter 7, after we take the lecture of today. So okay. I don't know if Your Excellency will make it next week or after next week.
Okay, let's look at after next week, because I've also posted assignment that that spread for 2 weeks. That will spread from when I posted assignment up to next week. So let's say after next week.
Okay, thank you.
Upper week. Okay, the quiz will be upper week after next week. Upper week.
Thank you.
Quiz 2. Okay, upper week. So in that case, next week the first few first few minutes, I will use it to review quiz, what you should expect on quiz number 2. Okay, since it's recorded, if you are not there, maybe you will get the recorded message and then you'll be able to review and revise for quiz number 2. Any other issue we can trash, or otherwise we start moving?
Thank you, Professor, for your sending chapters, all chapters. Now I have found in Moodle. Thank you, sir, for my lectures.
I've sent all the PowerPoints. So now that I've sent the PowerPoint, you have all the lecture materials, you have the lecture notes. So we'll be flying a lot. We'll be moving very, 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 very fast. If you don't understand anything, please call my attention. I should be able to explain. And also for a master's degree, especially MBA program, what the program entails is for us to be able to equip you in such a way that if there is a problem in your company or organization, you should be able to go, you know where to go and find solutions. So that is what MBA entails. It's a professional degree, master's degree program. So what the program entails you to do is we show you where to get, how to get the information. You go and look for the information. I will not be in your company, hence I will not be with you to start going to look for information for you. So it entails you to know where to get what, where to solve your corporate problems. So that is what MBA entails. I will now move, let me see if I can share my screen already. And then we move to, today we'll be looking at inventory, cost of goods sold, all those things that make up both income statement. You will see cost of goods sold on income statement. You also see inventory, especially ending inventory on the balance sheet. So we are looking at you will look at income statement is involved in today's lectures, and also balance sheets will also be involved. Because if you look at the balance sheet, what do you see? You will see inventory. Who can tell us where I can find inventory on the balance sheet? Under what heading? And why is it in that position? Who can tell us? Let me, while I'm doing that, let me upload. See, get. Who can tell us?
Yes, sir. Inventory. Yes, inventory is at the current. It's under the current assets in the balance sheet.
Very good. Inventory is under the current assets in the balance sheet. And in view of generally acceptable accounting principle GAAP, inventory may be maybe number 3 or 4 or 5 items in that order. Why is it number 3 or 4 or 5?
Yes, because the under GAAP principle, they started, the balance sheet starts with the current assets, whereas under the IFRS, the balance sheet starts with non-current assets.
Yeah, you got it a little bit. Both IFRS and GAAP, they start both with current assets. But the only issue is, the difference is that for GAAP, it starts with the most liquid of all the assets. And the most liquid of all the assets is what? Cash.
Cash.
It's cash. Okay. In that order, what would you think should be the next one? The next one is, in some cases, we call it quasi assets. Quasi. in the quasi-cash, that is like short-term investment. You know, we discussed short-term investment in your class, so like short-term investment will be number 2. You can see why is it number 2, because short-term investment mainly probably the company bought Apple as shares of public company like
man of God. I found that. Yeah.
So he bought shares of public company like Apple. So that is why it is number 2. Number 2 because for us to move it from number 2 to number 1, which is cash, the company will just sell those shares straight in the market and get the cash. So that's why it's number 2. Then we can have other items that be number 3 or number 4. But if there is no other closed liquid assets, then that is where inventory comes in. Why is inventory at that position? Is because before inventory is cash, you have, if it is manufacturing, you move it from raw materials to semi-raw materials, from semi-raw materials, then you move it straight to finished goods, and then you sell, and then you get the cash. So that is why it's right down the bottom. Okay, everybody see my screen?
Yes, we can see it.
Yes, Professor.
Okay, what did you see?
Yes, Professor. Chapter 7.
Very good, chapter 7. Okay, so this chapter 7 will be, now that you have the PowerPoint, like I said, you have everything you need to move forward on this course. I gave you chapter 7 early. I said, okay, you have to go through it before you come to class, so that we don't need to bother ourselves so much to repeat everything. What you don't understand is the only thing we will be focusing on, but at the same time, I will also want to deliver the lectures. Okay, so chapter 3 is interpreting cost of goods sold and inventory. And cost of goods, when we are talking of interpreting, we should have two different scenarios here. The first scenario is the company manufacturing. If the company is manufacturing, so the procedure is a bit different. If it is merchandising, that is like a company that is trading. So you should have manufacturing, merchandising. Before I move to the slide, for manufacturing, what do you think will be the stages of getting this up to cost of goods sold? Okay, the first thing is for us to talk about the inventory itself. Inventory is in manufacturing is raw materials, and then from raw materials, you will go to, with a little bit of inputs, factory overhead, you will move to semi-finished goods. Okay, from there, from semi-finished good with another input added to it, labor and supervisory and all those stuff. So then it will move from semi-finished goods to, actually will move now to finished goods. So you can see it will take from raw materials to semi-finished goods to finished goods. For merchandising, as soon as you get it, that is a finished goods. So that will be finished goods. So it will just move straight away to I don't know why my system is moving. Okay. So I don't know why it's moving. Why is it moving? Sorry. 1 minute. I don't know what is wrong here. What is wrong? Okay, all right, we can leave it the way. Let me just go back. Okay, so it's good to distinguish between manufacturing and merchandising. For merchandising, you can see that we are dealing with finished goods. Who can give us example of a company we feel is merchandising that it will start straight with finished goods? Who can give us a good example? You can unmute and give us a good example. Nobody? Okay, example of merchandising is trading company, trading. For example, who knows something, everybody knows something about Walmart. Walmart is a merchandising company, it's a trading company. So what they receive is not raw materials, they are receiving finished goods. So as soon as they receive finished goods, they send it to their stores and start selling. But for manufacturing, what they get is the raw materials. So they start with the raw materials and then convert it to finished goods. Okay, so we have about 6 learning objectives here. Apply the cost principle to identify the amount that should be included in the inventory. Report inventory and cost of goods sold. Like I said, in that case, when we are looking at the learning objective 2, we are looking at 2 different statements. We are looking at income statement, because that is where cost of goods sold will be posted. And then we are looking at inventory as well. So inventory will be on the balance sheet. In most cases, that will be the ending inventory. Then objective 3, we'll look at, we decide when to use different inventory costing methods. Last time I quickly introduced it, I said we have the LIFO, that is last in, first in, out. We have the FIFO, first in, first in, out. We have the average balance method. And there are some small companies that just, they identify the actual inventory, the actual number or goods. But for big companies like Walmart and very, very big company, they use those 3 methods I've just mentioned. That is LIFO, FIFO, and average balance method. So later on, we'll concentrate on those 2 methods, or 3 methods. So primary goal of inventory, well, for companies, they want to have sufficient quantities. And then they also want to minimize the cost of carrying excess inventory. Because if you carry excess inventory, it's just like a company is tying their money down. The company will not want to tie their money down. So they will devise a method whereby they will be able to have sufficient enough to either sell or to produce the goods without really having any excess inventory, and except maybe during seasonal, where maybe during seasonal when their product will be very, very high in demand. Okay, look at Exhibit 7.1, income statement and balance sheet. Like I said, you will see that these 2, income statement and balance sheet, will always be our focus when we are discussing inventory. Because if you look at it, cost of goods sold will appear on income statement. That is the first bulk expense to the company when they are selling. After you look at net sales, then you have to deduct cost of goods sold. So whatever you arrive at is what we call the gross profit. Cost of goods sold, the net sales is 5.3 million. But if you subtract cost of goods sold, 3.2 million, you arrive at what we call gross profit. And here too, you will be able to also note gross profit margin to really know if the margin is reasonable enough, if it is within industry average, if they beat their competitors or they are performing better than industry average. Here you know the gross profit margin based on the cost of goods sold. And then on the inventory, when we move from then that to inventory case will always appear on the balance sheet itself. So on the balance sheet, you will see that you will see the cost of inventory clearly stated. So like now we have assets, cash and cash equivalents, marketable security, account receivable finance, then you can see where inventory now falls. Because before you move inventory to cash, you have to pass so many stages. But cash, you know, you have cash already. Marketable security, you go to the market, you sell the marketable security, and then you move you to the next stage of cash as well. Account receivable, as soon as you get the money from the debtor, it becomes cash. So that's why inventory net is here at this point. So that would be the balance sheet. Balance sheet is where we capture the ending inventory. So now we're talking about applying cost principle to identify amounts that should be included in the inventory and cost of goods sold. For a typical retailer, wholesaler, manufacturers. So manufacturers are always different from the merchandisers. That is retailers or wholesalers, they are merchandisers. So item included in the inventory, we have for merchandisers, like I said, is just finished goods. It would be merchandise inventory. So, but for the manufacturers, you can see what we talk about here. What they have is raw materials. Like they get the plastic, the pallets which they use to produce plastic pails or plates. So it will start from raw materials, work in progress, or semi-product, and then it gets to finished goods. So we have discussed that already. So inventory here, you can see raw materials. How do we get that? Raw material and work in progress. So raw materials, if raw materials is maybe 150, then any difference will be work in progress. All that put together will give you what we call raw materials and work in progress. And then if you look at this company, Harley-Davidson, they manufacture motorcycles. So motorcycle finished goods, you can see the finished goods here. Then accessory, general merchandiser, and then inventory, a lower of FIFO cost on net realizable value. So in this company, they're using FIFO. So we will have opportunity to demonstrate how those three items work. So we'll have that opportunity to look at them. So costs included in inventory purchases. Costs included, number one will be the main inventory itself. The main, if it is manufacturing, the main raw materials will be the first items. And you should know that if they buy the raw materials from the farm, whichever place they bought the raw materials, the next thing will be for them to transport. So now that is where the freight charges will be there. like cost of transportation will be the next items there. And then when they land in the factory now, they have to offload it into the warehouse. So all those will be costs that will be imputed. So in that case, we have invoice price, freight in, and then inspection cost. Probably if there were inspectors need to inspect those materials, there will be a cost. Then preparation cost, purchase, then we have what we call purchase return. Just like for us to arrive at net sales, we have to look at possible return, possible discount. We get those two adjusted before we arrive at what we call total inventory costs. Any questions so far? Any questions so far?
Professor,
yeah.
It's not related to the subject, but the slides, are you moving the slides? Because with me it is frozen.
Oh, it's not moving?
Maybe with others it's moving. I'm not sure.
Okay,
No,
let anybody.
No, same here. It's not moving because I've texted the students to ask them if they're having the same issue.
Okay.
It's not moving at my end too.
Not moving.
Oh, wow.
Now it's
all right.
correct.
Maybe
Now
okay.
I
will quickly review the slides again. I will quickly. So do you see this slide now? Reporting inventory.
Chapter 7, Chapter 7, sir.
Do you see reporting and interpreting costs? That is chapter 7.
Yes, sir.
Okay.
Yes, the red slide, the first slide.
Okay, I moved.
Objectives.
Slide.
Objective.
You see it?
Yes, sir.
Okay. So we have talked about learning objectives. We have 6 of them to quickly go through. We talk about understanding the business, primary goal of the inventory. We talk about it already. Okay, that one, the company must have sufficient inventory. And the other aspect, they have to balance with need and want. I know you guys are doing economics, so you know what I mean by need and want. Yeah, that is what they actually want to use the inventory for, as opposed to just getting inventory there. So that would be because if they put excess inventory there, that will cost them extra money. Instead of putting the excess inventory, why can't they take that excess money or capital and invest it in marketable security to bring more money instead of tying it down on the inventory? So it's very important that the company must balance between sufficient quantity and minimize the cost of carrying excess inventory. I move to slide 4. Did you see slide 4? Exhibit 7.1. Yes. Very good. Okay. In slide 1 here, I said it when we open up. I said, well, we have 2 accounts we are looking at where inventory and cost of goods sold will appear. Income statement will always carry cost of goods sold. And this first bulk expense of any manufacturing company or even merchandising company is cost of goods sold. That is where the inventory cost will appear. So in this case, look at this company, Hartley Davidson. Cost of goods sold is 3.2 million in 2019. Net sales, you always subtract cost of goods sold from the net sale, which is 5.4 million. And then that'll give us a result of 2.1 million. Okay. And then look at in balance sheet, we are looking at inventory. I told you inventory is right down the bottom of current asset because it is not readily liquid. Everybody still follow my slides?
Yes, sir.
Okay. Okay. So it's not readily liquid because of that inventory right down the bottom. While cash is on top. You can see marketable security is next to cash because it's like quasi-cash, semi-cash, because if marketable security means I can just go to the market and sell those shares, those public shares, and they give me the money straight away, or the company. Okay, then we talk about learning objective 1, applying the cost principle to identify the amount that should be included. We talk about the invoice amount of the, if it is manufacturing. Let's look at the manufacturing. If it is manufacturing, we are looking at the raw materials. The raw material is 50,000. Then from the raw material factory where they got the raw materials, they need to move it to the company, the factory, where they're going to produce the goods. So that will be, it will capture freight charges. And when they come down to the company's factory, they have to also offload, and that will cause them, then prepare the materials and so forth. That all will cause inputs into that inventory. So like merchandise, they don't need to add anything because that is finished goods already. Merchandise, they just invoice them, add freight charges and maybe offload charges and so forth, and that will give them the result is the inventory. But for manufacturing, there are so many stages, like I've mentioned before. So now, when we look at inventory, we look at inventory here, raw materials for Hartley Davidson. You can see the raw material and work in progress. You see the finished goods, everything put together, and then accessories and general merchandise amounted to 659,000. So, but in this case, you can see that they're using what we call FIFO. We'll go through the FIFO in due course. Okay, costs included in inventory. So you have to take note of those costs as I discussed. The invoice price is the invoice of the main material or goods. For manufacturing, the main raw materials is the invoice price. Then the freight, that is cost of transportation from where it was purchased to the factory. And then the inspection cost, preparation cost, all add up to call the total inventory cost. Any question so far? Do we have question? If there is no question, we keep moving. Okay, so applying materiality constraint. So most company report inventory costs as, like I said, invoice price, less return, less discount. You can see same thing the way we start with gross sales. We say less return because there may be some items of the raw materials that may not be good. So the company needs to return back to the company that sold them those raw materials. Or if it is finished goods. For example, a big company like Walmart is purchasing 500 from Samsung. So out of the 500, probably there may be some that are not good, maybe 2 or 3 not good. So that they will return. So that will reduce the cost of that inventory. And then Samsung may say, well, being Walmart, you purchase a lot from us, so we give you a discount. So that discount will also reduce the cost of inventory. So now, when we do those adjustments, we arrive at what we call total inventory cost. Okay, look at this example, exhibit 7.2, flow of inventory. Flow of inventory cost. You can see that the A there is merchandiser. Merchandiser. Those who they have the finished goods, there is no need to add anything, any input to that finished good. It is finished goods, ready to go, ready to sell. Like Walmart, they have 500 television that have just arrived in the store. So they have nothing to do other than to bring it out to the outside and start selling. So in that case, we'll have merchandiser inventory, and then whatever they are taking out of inventory to sell will be the cost of goods sold. That's for the merchandiser. And then for the manufacturer, you can see what the stages are. I emphasize on merchandiser and manufacturer because I want you to really appreciate the difference between the two. For the manufacturer, you see, they start from raw materials, inventory, work in progress, inventory, and work in progress, or you may call it semi-goods. It is not yet complete, so they will still go to the finished good. Like for, let us say, like for Davidson that we are looking at the work in progress, that is semi-product. Probably they are put the machine, they prepare motorcycle, everything, but the tires are not there. The spraying, the painting not yet complete. So when they move to the finished goods, they have put the tires, everything is looking new. Now it's ready to go. So that would be for the manufacturing. You see, work in progress, like I said, at this point, they have added some overhead expenses, that like the direct labor incurred. That is why you see work in progress. What is the difference between work in progress and raw material? Is because they have added the factory expenses and some direct labor to transform the raw material to something semi-product. So like the example I've given. And then from there, they will now add the final inputs, and then the thing result to finished goods. So that is what we call the cost of goods sold at that point. Okay, let's look at cost of goods sold for merchandiser inventory. You can see how do we get the cost of goods sold. If you look at the balance sheet before, let me say, balance sheet for January 01, in this case, it was 40,000. And then they say, okay, we have open inventory 40,000 as of January. Okay, let's purchase additional. They purchase additional 55,000. So that total together, put together, will give us 95,000. That 95,000 is not cost of goods sold because they may not sell everything. So that will be goods that are available for sale. So the value of goods is 95,000. We'll know how to derive that 95,000. 95,000 is the goods that they have now. Opening inventory is 40,000 plus 55,000. That become cost of goods sold. That become goods available for sale. 95,000. Then look at the arrow here. Then from here, they took 60,000 of the goods for sale. When they take 60,000 of the goods for sale, they have something left. What is left is what we call the remaining inventory or ending inventory. This one, the 60,000 they extracted for sale, goes to the income statement. Who can tell us why? Who can unmute and tell us why? They have taken 60,000 from the available goods for sale. And that, I said, that will go to income statement. Why? Yes? Okay, I don't need, okay, go ahead. Go ahead if you want to answer the question.
Okay, yes, because cost of goods sold is is found in the income statement, and less cost of goods sold from the total cost of materials available for sale.
Okay, that's good.
While this other one, the ending inventory, this is the stock at hand or inventory at hand after the end of the business year. So we report it in the financial statement, in the bank statement.
In the balance sheet statement. That's very good. I don't need to add anything there. The only thing is that the 60,000 is cost of goods sold, and that is the first bulk expense of the company. So the moment out of that 60,000, when the 60,000 probably, when they sell this 60,000 out, they sold it because they will sell it at a level of profit. Probably they sold it 85,000. So you can see 85,000, then they post the 60,000 as cost of goods sold to the sales, to the income statement, and the difference here is 25,000. This difference of 25,000, what will it? What do we call it? What do we call? Now they were able to sell this inventory for 85,000. Cost of goods sold now is 60,000. So there's a difference of 25,000. What do we call it in income statement?
Revenue? Is it revenue?
Is revenue, but what do we call it? It may be revenue, maybe. But what do we actually refer to it? I mentioned it in 1 or 2 slides ago. What do we call it?
Gross profit.
Very good. That is gross profit. And from here, we can deduce what. Yeah.
I'm listening to online. I'm listening to online lectures.
Oh, okay. Okay. All right. So what we have it there is that is a gross profit. And from here, I say we can get what we call gross profit margin. Gross profit margin 25. The gross profit margin is GP, gross profit divided by the net sales. Give us what we call gross profit margin. Very important measurement as well for the profitability of the company. Okay, so that is the equation there. Beginning inventory plus purchase will give us goods available for sale. If you go to the balance sheet, beginning inventory as of January 1st, if the company financial period is from January to December, so 1st of January, you will see what you have there become beginning inventory. And then when you add purchases from that January to December, at the end, whatever you see there become ending inventory. Ending inventory. So if you subtract ending inventory for sale, then that is how balance sheet is being prepared. That is what we end up with cost of goods sold. So that is BI, beginning inventory, plus P, purchases, minus ending inventory is equals to cost of goods sold. So it's good to take note of that equation. It's very standard. Okay. So let's see, let's calculate cost of goods sold in this case. Assume that Hartley Davidson began the period with 40,000 worth of inventory or worth of motor clothes in the beginning inventory. Purchasing additional inventory during the period is 55,000 and had 35,000 left in the inventory at the end of the period. The amounts that are combined is as follows. So cost of goods sold in this case, you will see that it will be 60,000 because beginning inventory is 40, purchases is 55, add the two, give us 95. But at the end of the year, they still have 35,000. So that means whatever is the difference between goods available for sale and ending inventory should be cost of goods sold. Any questions? Same also for merchandise. Merchandise is always very straightforward than manufacturing. Yeah, we have what we call perpetual and periodic inventory system. Company use any of these methods to maintain and manage their inventory. So for the perpetual, purchases transactions are recorded directly in inventory. So that means sales required 2 entries, sales and cost of goods sold. But for periodic, they don't do no updates. They don't do any updates. So most companies use a perpetual system of inventory, whereby they will update as they receive purchases, and then as they sell, they update the sales and the cost of goods sold. Okay, let's look at reporting inventory and cost of goods sold using the 4 inventory method. I mentioned the 4 inventory method at the beginning. So let's look at them again. At the beginning, I mentioned these 4 methods. Specific identification, that is, the goods are being identified. Oh, what good is this? This is the one we are going to sell. And then first in, first out is another method. The second method, last in, first out, LIFO, third, and average cost method. And I will tell you, the first method is specific identification. Yeah, for a very, very narrow and small company, that is possible. You can just identify which one are we going to sell. But for very large companies, it's not possible. That's why we will look at the first 3 of these 3 methods: FIFO, LIFO, and average cost method. And for FIFO, what is it? You just look at, you say first in, first out. If you understand that principle, because as you get in inventory, for example, let me say this is July 1, 2, we have only 3, today is 3rd. July 1, they receive 10,000 worth of inventory. July 2, they receive 5,000. And July 3rd, they receive, say, let me say 3,000. So what do you think will be the total inventory here? What will be the total inventory? Who knows? That is from my own example. July 1, 10,000 what? July 2nd, 5,000. Today, being the 3rd, 3,000. What will be the total inventory?
18,000.
Huh?
18,000.
Is it? Okay, that would mean the total inventory, very good, is 18,000. So I want to explain each of this method, and then from there, we will now run through other slides when we come back from break. The first is FIFO, first in, first out. So now, supposing they were able to sell, let me see, they sold 9,000 worth of inventory. They sold 9,000. So now, how do you classify the remaining inventory? First of all, you have to know what cost of goods sold is based on, okay, maybe I don't want to give you the answer. Let me put it the other way around. Supposing the 10,000 here is 10 items, 10 10 items received. That means each item costs 1,000. 5,000 would be 5 items. 3,000 is 3 items. So supposing 7 items are being sold, 7 items. So how do we calculate? So the question we'll be having now is, what is cost of goods sold for these 7 items? Based on my example, you can write my example down 10,000, 10 items, 5,000, 5 items, 3,000, 3 items. So the total here gives us 18,000. So now out of this, okay, you can see that 10, 5, 18. Incidentally, 18 items were received. Total inventory received 18 items, and the value of that inventory is 18,000. So out of the 18,000, 7 items was sold. The question is, what is the cost of goods sold and what is the ending inventory? So take note of those, my examples, write it down. When we come on break, we'll take 15 minutes break so that we can relax and come back. After the break, I will expect maybe you guys to give me the answers to that. What is the cost of goods sold and what is the ending inventory? Let's take 15 minutes.
Excuse me, Professor. Can anyone hear me?
I can hear you, Awad.
I had some internet issues, so I was not able to listen to the question of the professor. Can I have some details about it, because I didn't hear anything at all.
I'm a bit confused too, so it's not clear to me. But he said on June 1, we have a 10,000 inventory, I think. I'm not sure, but on June 2, we have 5,000. On June 3, we have 3,000. So total 18,000. And we have orders of, I think the money is like that, and orders of the inventory, I think he said 7. So
yes, Rodas, I think you are right. But
I'm
he
right?
did mention for the 10,000 on purchase on the 1st June, right? They purchased 10 units. So basically each unit actually costs 1,000. Same goes to the 2nd of June. You will purchase 5,000 for 5 units. So the individual units still worth 1,000. And same goes to the 3rd June. 3rd July is 5,000. Is it 3,000? 3,000 purchase of 3 units. So
June 3rd.
unit,
July 3rd. Yes.
yeah. So the unit is 3,000. So if they were to purchase, I mean, I think if I'm not mistaken, it's 7 units.
He said
So what
7,
is
yes.
the 7 units, right? So what is the first in, first out of it, and what is the balance of the inventory?
No, so
Yes, he asked for ending inventory.
So if the items are each unit equals 1,000, so we have at the end 18,000. No. If we will have a total of 18,000.
Yes,
which
correct.
will make sales of 7,000, right?
Yes, correct. And the balance will be
7 items.
7,000.
Yeah, because the purchases on 1st July, 2nd July, and 3rd July is the same unit rate. So let's say they were to purchase on 7, total unit of 7. So regardless of first in, first out, or last in, last out, the result is going to be the same. So the 7 unit, since they are all worth 1K for each unit, so basically for 7 unit is 7K.
Hold on.
For 18K, yes.
Hold on. On June 1st, we purchased 10 items with total of price with price of 10,000, right?
Yes, correct.
Okay. And in June 2nd, we purchased 5 items. The cost is 5,000.
Yes, correct.
And in 3rd June, we purchased 3 items with a price of 3,000.
Yes, correct. You're right.
Okay. So the total cost is 18,000
Yes, 18,000 for 18 units.
for 18 units, regardless of when it was purchased, because it is the same price.
Yes, you're right. Unless the 1st July, the 2nd July, and 3rd July, all of them have a different unit rate, then the method used will be different.
Exactly. If it's all the same price, then it doesn't matter the method, because it's the same price.
Yes,
But if
correct.
it's
So
different
yes,
prices, then it will affect.
yes, correct. So basically, Professor just giving his example, so he want us to give him what is the total the cost of the goods sold and the remaining inventory. So I believe it's like the cost of goods sold is around 7K, then the remaining is going to be 11K. I think that's what he wants only.
Okay. Thank you.
You're welcome.
Hey, I know. By the time I was like, am I sure you understand? Sir? Maybe I should have made more clear. Yes. It's true. Sir. I mean, those
Hello, I am way back. I am way back.
Yes, Professor.
Yes, we were, I was looking at an example we were looking at. I don't know if, okay, for the example, I want us to write it down and do some amendments. The first one is July 1. Supposing this company, July 1, they received $10,000 worth of items at, it was $1, and so the unit will be 10 units. 10 units was 10 units of items received on July 1. On July 2, 5 units at $2,000 was received. On July 2, 5 units at $2,000 per unit. So on July 3rd, today, they also received 3 items. July 3rd, they received 3 items at $500 per unit. So now what we'll have on July 3rd, 10 unit received at 1,000, that will be $10,000. I want everybody to write that down. $10,000 because 10 items or units were received at 1,000 on July 1st. On July 2nd, 5 items were received, and it costs in this case 2,000 units, $2,000 per unit. And then the July 3rd, the item went down to $500 a unit, and 3 items were received or purchased. Anyone who wants to be just. So in that case, total number of units received for the 3 days, 10 plus 5 plus 3, 18 units. Okay, so now if we want, supposing our company is using the FIFO method, what will be the cost of goods sold? What will be the ending inventory? So you can see that the inventory here will be 10,000 plus 10,000 plus 1,500, that will be 21,500. If you can write it down, because I'm going to ask questions and see if we have been reading the notes. So 21,500 is the total goods available for sale. Using the FIFO, we are looking at first in, first out. So using the FIFO, who can tell us what the cost of goods sold will be based on my own scenario? Who can tell us what the cost of goods sold is?
Professor, okay. How many units? How many units?
Okay, I will repeat it. July 1, number of units, okay, was 10, and the cost per unit is $1,000. So that means on July 1st, they received 10 units at the cost of 1,000, so that is $10,000 inventory was received. On July 2nd, number of units, 5, and the cost of each unit was 2,000. Maybe the price went up that day, yesterday. And then if you look at it, the cost of inventory received will be 10,000 again. On today, as we were just coming to class, they receive another inventory. This time they received only 3 units. They received 3 units, and at 500. So these prices will fluctuate at $500. So that means if we look at it, the cost of inventory is 1,500 in this case. Only 3 items received and at 500. So in this case, we have 20,000 plus 20,000 plus 1,500. So what will be the total cost of total goods available for sale? Total goods available for sale.
21,500.
Very good, 21 total. So you can write that total goods. If you understand my example, then you should get everything about the slides. Total goods available for sale. Available for sale is 21,000. Okay, now let's look at the first items there. Like I said, we should be looking at first in, first out, LIFO, and average cost, because the first one is not really a unit method. It's only for very, very small company that have very tiny inventory. Okay. Okay. Yeah, please, you could reduce a little bit. Okay, so let's look at the FIFO first. FIFO method. Under the FIFO method, we have to calculate cost of goods sold. And then we have to also calculate ending inventory.
Professor.
Yes.
How many units are sold already?
Okay, that is the one I didn't
give
put.
us this.
Okay, I gave you an example. I said, supposing units sold. Units sold 7. 7 units were sold. Okay, thank you. I said it in the previous. I said, assuming 7 units were sold before we went to break. So let's still assume that 7 units were sold. For under FIFO, what is the cost of goods sold and what is ending inventory?
The cost of goods sold is 7,000.
7,000?
Yes.
How did you get? Can you explain how you get 7,000?
Because we're using the FIFO method, it's a first in, first out. So on July 1st, we purchased 10 units, but we only need to sell 7 units. So we had to deduct from the first purchase there first.
7,000. Very good. Then what is the, continue because you are the one to answer the next question. What is the ending inventory?
You have to take the 21,500, deduct the 7,000, so you will get 14,500.
14,000, perfect. 14,000. So do you see? So now cost of goods, so where will it go? The 7,000, where will it go? Who knows? Where is the 7,000 going now?
Income.
Which statement will it go to?
Income statement.
Very good. This will be posted in the income statement as cost of goods sold, which is going to deduct from the net sales. So so now the ending inventory, where will it go?
Balance sheet.
Balance sheet. So the income statement for the cost of goods sold, ending inventory to the balance sheet. Very, very good. Okay, somebody else tell us what if this company now is using LIFO, what will be the cost of goods sold?
I can go with that.
You are the one who answered the previous one, right?
No. That was good. That's me, Ahmed Awad.
I answered the
Both of you start almost the same. Okay, you go. Okay.
So if we go with first in, last out. Okay.
No. We are finished with first in, first out. Now we are looking at last in, first out, LIFO.
Yeah, sorry, last in, first out. So the cost of goods sold will be 9,500 because 3 items at the rate of 500 per item. Okay. And 4 items at the rate of 2,000 per item. So the 4 items will be 8,000, and the 3 items will be 1,500. So total of 9,500, which give us an ending inventory of 12,000.
Very, very good. I'm so proud of you guys. So the ending inventory is 12,000. So the 12,000 go to balance sheets, and then the 9,500 will go to income statement. Very good. As cost of goods sold. Very good. Okay. I know this is slightly a bit difficult, but it's not quite difficult. Who can take care of the average cost? Who can help us? Average cost method. Who can help us there? Average cost method.
I can go ahead.
Huh?
I can answer for it for the average cost.
I can answer also.
I think it's 8,000.
I want somebody who have not answered. I want somebody who have not done it.
Oh, okay.
Maybe a lady this time. Can a lady try? I know we have very smart ladies there. Can a lady try this time? Okay. Maybe they are shy, they don't want to try. Okay, is there anybody other than the two people that have given us answer? Try with the average cost method. Average cost method, who can try? Give us cost of goods sold and ending inventory.
Professor?
Oh, yeah.
So is the average cost calculated by taking the first in, first out plus the last in, last out? I mean, last in, first out, and divided by 2?
No. Okay, let me let me be the one to take that. Probably that is I don't know, maybe slightly a bit. Or is there anybody who has a good answer? Or okay, let me try that. The average cost here, we are looking at all the inventory that have been purchased from July 1st to July 12th. We want to know the costs, the unit cost, because the rest we're able to get for FIFO, LIFO. We know the unit cost is 500, 2,000, 1,000. But for average cost method, we want to average the unit cost. So in that case, the first thing we will do is to find the average so that we arrive at the unit cost of the average. So the first item was we purchased 10 items at 1,000 each. So that would become 10,000. Okay. So the next item, we purchased 5 of them at 2,000. That's another 10,000. Then the last one, we purchased 3 items at 500. That gives us 1,500. So if you add this all, we know that it is 21,500. So now the question is, how many units were purchased? 10 plus 5, 15 plus 3, so 18 units. So now we divide 21,500 by 18. So what will be the numbers? I have my, anybody who is faster than me should do it. 21,500 divided by 18, that is the number of units. So that gives us $1,194 on the average. So now we know the unit, we know the average cost. So now how many items were purchased or were sold? 7 units. So 7 units will be 7 multiplied by the average cost, which is 1,194. So if you multiply that, 1,194.
8,361.
8,361. 8,300.
Yes, correct.
8,361.
Yes.
Yes.
Okay. So you can see under the 3 methods, we have different, that will be this is the cost of goods sold. In this case, what is the ending inventory? Ending inventory. What is the ending inventory in this case? We have the 8,361 is the cost of goods sold. What will be the ending inventory?
I think it's 13,138.
13,138.
38.
Okay. I would take that if it is, that is, you are subtracting 8,361 from
21,500. Oh,
from
my mistake. Yeah.
Okay. That may not be, is it correct?
It's correct, it's correct. It's 13,138.89.
89, which is call it 1,139. Let's put it 139, okay? So that means you just subtract what you have now as the cost of goods sold from the available for sale, and then we have 13,139. So you can see under the three methods, we have different cost of goods sold. We have different ending inventory. So, and now you ask yourself, which method is the company motivated to use? That is the question you will ask yourself. You can see under this method, under the FIFO method, we have cost of goods sold to be 7,000. Under the LIFO, we have cost of goods sold to be 9,500. And under average cost, we have 8,000. So in most cases, it's always like this. You have the cost of goods sold, you have the FIFO, and then the average cost method is always in the middle of the two. You can see cost of goods sold is 7,000 under FIFO, LIFO 9,500. So now average cost is 13,139. You can see that average cost in the middle. And I will tell you, average cost is always in the middle, depending on whether it is rising cost or the cost is reducing. That is, rising cost means maybe due to inflation. January, you purchase 1,000. February, July 1st, you purchase 1,000 units. That is, unit cost is 1,000. You can see in July 3rd or 2nd, the unit cost increased to 2,000. That is rising cost. And then you can equally see in July 3rd, it reduced. But then, assuming in July 3rd, the thing keep increasing, you will see that you will be increasing. And then in that case, FIFO will always come in the, FIFO will come first. And then average cost method will come in the middle, irrespective of whether it is rising or is reducing. So the company will be motivated depending on how they want to report the income statement. And you should know also that if in this case they will want to use FIFO because cost of goods sold will be 7,000, they will report more income. Am I right or wrong? Well, they will report more income. So supposing now the income is, let me say the income, the sales, unit sales. Supposing the unit sales is, say, 27,000. Let me use a number that will make it easy for us. 27,000. So that means gross profit will be less 7,000. That will be 20,000. For FIFO, 9,000, 5,500. So 27,000 subtract 9,500. So you can see the unit cost in this case will be 17,000, lower than 20,000. And then average cost methods, you can see that 8,361. So if you subtract that, the difference will be about 19,000 something. So if the company use the FIFO, they will report more income. In this case, if they use LIFO, they will report the least of the income. If they use average method, that will be second to FIFO. So company depends. But if they want to report more income, yeah, they will use FIFO. And then what happened to paying tax? They will pay more tax in this case because they are declaring more income. So motivation will depend. And in most cases, company may say, okay, in terms of reporting more income because the investors, the owner of the company, that's the shareholders, they're interested to see their investment appreciating in terms of profitability. So management will report, maybe use LIFO in this case so that they can make the shareholders happy by reporting more income. But when it gets, in that case, they will use FIFO. But when it gets to tax consideration, they may say, wow, why don't we use the one that will report less income so that we will pay less tax? So everything depends on the motivation of management. Okay, any questions so far?
Professor, can you repeat which has more income, the LIFO or the FIFO? Is it the LIFO, right? The last in, first out, right?
It depends on the rising cost. Rising.
Oh,
okay, it depends on the cost. Okay, like if January 1,000, okay, unit cost. Per unit is 1,000. Then in July, per unit is 2,000. Let us assume on July 3rd, the unit increase again to 2,500 instead of 500. So you can see that this is the unit is rising. So unit is rising. So now if we use FIFO, let's start. Yeah, if we use first in, first out, what do you think? FIFO will report the least.
Yes, correct.
Yes.
Yes.
So they will report the least, and that will be more income. You get it? Like I said, whether the price is rising or the price is coming down, average balance method is always in the middle of the two. You get what I'm saying? Average balance will always be in the middle. So now you can see that because FIFO will pick only first thing, so only the item that costs 1,000 is what FIFO is going to use. Meanwhile, as of July 3rd, the price is now 2,500. Now, let's all reverse also. If it is 2,500 in July 1 per unit, and in July 2, the thing reduced to 2,000. It reduced to 2,000, and the July 3rd, the thing further reduced to 1,000. So you can see now, if we use FIFO, when the balance, when the unit is reducing, in this case, the unit price is 2,500 on July 1. It moved to 2,000. Now it's 1,000. So for FIFO, you are going to use the most expensive units, which is 2,500. So in that case, FIFO will be more, it will report more cost of goods sold and less income.
Yes,
whereas
understood.
Whereas last LIFO will report the list because in July the items have reduced to unit of 1,000 per unit. Did I make myself clear?
Yes, Professor, it's very clear now.
Okay, so these are the examples that I use my own example in this case. So you can read the example, it's the same thing. You can see they are using January 1st, what was purchased and so forth on 12 and 14. So you can read that on your own if you want to. I have explained all those things that you need to, first in, first out methods. So we have done that. I want to see where we're supposed to be, and then we continue from there. If there is any, look at this, average cost method. Now we know how to calculate. Who still want us to explain average costs? Okay, so it's the same thing. Just find each of those prices, multiply by the unit, divide by the total unit, you have the average cost, multiply by what is sold. That is when you get the cost of goods sold. And then subtract that from the available for sale. Then you arrive at cost of, you arrive at the ending inventory. Okay, so that is what we have covered all those. You can see here, financial statement effects, increasing cost. This is what I've just doubled into. So you can look at it, it's standard here for you. That I have been able to explain how it moves. Even if you are doing a test and you don't know, you just use a scenario. So, okay, July 1st, unit 1,000. July 2nd, unit cost 1,005. July 3rd, unit cost. That is increasing unit cost. And then you look at decreasing. You use a good example and make it more practical for you to understand the implication of it. Okay, we have covered is deciding when the use of different inventory costing method is beneficial to a company. We have talked about in terms of tax consideration and in terms of reporting higher income. So we have talked about all that. So that is why I am just going past that. Then ethics. The selection of inventory method can have significant effect on financial statement. And most cases, for picking which inventory to use is based on the company's policy in most cases and the motivation behind it. The company may say, okay, our one is to report higher income, or to be conservative and report lower income. And then depending on the time, if it is rising costs or it's a time where the prices are falling. Okay. Okay, so in the balance sheet, generally, the balance sheet always look at cost and net realizable value. The two statements may look the same, but they may not be the same. Lower of cost of inventory, what we just calculated. And at times, the market unit cost may be different. When at the time they say, okay, we want to liquidate this company or want to sell. The net, what will they realize per unit will be different from the cost of inventory. So depending on that, and the balance sheet will always report net realizable value of inventory. So let's move to something I think if I've not talked about. Okay, understanding method of controlling inventory and analyzing effect of inventory error on financial statements. So this is where internal control comes in. After cash inventory is the asset's second most vulnerable to theft. So efficient management of inventory becomes inevitable. So there must be, the key responsibility is to separation of responsibilities. Who handle inventory, who handle the books. So it depends. You cannot allow one person to handle the inventory, physical inventory itself, and also handle the books of inventory. The person who handles the physical should be able to tell us, okay, I have $10,000 worth of inventory, and then the person who is looking at the books of the inventory should be able to come back and say, oh, it is 10,500 I'm having in my books. In that case, they can work out the difference. And that will forestall possible theft of inventory. And another thing is that no management want to tie inventory down. No management want to tie inventory down. They want to make sure whatever they are selling fall in line with what they have in stock. But at the same time, so there must be a compromise. At the same time, they don't want a situation whereby, oh, we need 500 units of finished goods. Oh, we don't have. Oh, because we don't have inventory. So they should be able, based on management experience and so forth, they should be able to tie between what they will use to produce the goods or sell to what they are expected to keep. Some companies may keep, say, okay, plus or minus 20% of whatever we have been able to sell or produce. Based on company's policy again and experience, the company will be able to do that. There is no clear answers to it, whereby you say, okay, for this company, this is it. Or this company must keep this level of inventory. So errors in measuring inventory, errors also, like I said, whoever is keeping the books and the physical inventory, they must always be the same. And yeah, occasionally they will do the audits and see if there are differences. If there are differences, then they should be able to reconcile. And you remember the equation for the inventory? Who can still remind us of that equation for cost of goods sold and inventory? Who can remind us that? Who can still remember the equation we just discussed? How to calculate cost of goods sold based on the inventory? Who can remind us? Nobody again? Do we talk about ending inventory? Ending inventory, add purchases, and then you have available goods for sale, and then we subtract the cost of goods sold, then we arrive at ending inventory. That is a standard equation. So one or two numbers may be missing, and you are told to find the other number. If I don't give you ending inventory, beginning inventory, then I've given you purchases, I've given you cost of goods sold, I've given you ending inventory. You should be able to calculate beginning inventory. Any question?
No question.
Okay. All right. So whatever we do also have their key ratios. So we have inventory turnover ratio here. And how do we calculate it? Turnover ratio is equal to cost of goods sold. And now we know how to calculate cost of goods sold all over average inventory. Why do we say average? Why don't we say inventory? Cost of goods sold divided by inventory. Why don't we say that? You can tell us why we say average inventory instead of saying cost of goods sold divided by inventory should give us inventory turnover. Why are we using average? Why are we using average? Who knows? Who knows why we are using average in this case? Average inventory. That is why you have your PowerPoint, you have the notes. These are some of the hidden questions that we need to know. for you to be able to manage your inventory professionally and to do calculate your ratios. These ratios are very important to the performance of each company. Okay, average inventory, because inventory, any item that is balance sheet, I want you to take note of it from now on. When we are using any items that is a balance sheet item in calculating ratios, we have to find the average, because balance sheet is a snapshot as at the beginning and as at the end. So when we add the two, we divide by 2, we have a reasonable numbers to use. So what we have looked at now is inventory turnover. And it is cost of goods sold. If I ask you what is inventory turnover of this company, you should know that it is cost of goods sold divided by average inventory. So in that case, pick the 2 beginning inventory in the balance sheet, ending inventory in the balance sheet, add it, divide by 2. And then you also calculate cost of goods sold. And then you are able to find inventory turnover. And how do we measure this in terms of performance? The higher ratio indicate that the management of this company are utilizing their inventory as quickly as possible. They are utilizing their inventory as quickly and professionally as possible. So the higher ratio is a better ratio than the lower ratio. Any questions there? Okay, average days to sell inventory, average days. So now we know the inventory turnover. Now we know that if we divide 365 by the inventory turnover, so it reflects the average times this inventory has been turned around. That is, the ratio reflects the average time in days it takes for a company to produce and deliver inventory to customers. So number of days, and it depends on the industries. It depends on industry. A company that produces cars, you don't expect the average days to sell inventory to be lower than a trading company that only sell manufactured goods, or a company that manufactures very few small items like plates, plastics, cups, and so forth. So average days to sell inventory will be 365 divided by the inventory turnover. Now you know what inventory turnover is, and you know the implication of inventory turnover. You should know as we discussed, we should know the theory behind the numbers as well. So inventory method and financial statement analysis, converting income statement to FIFO. So the choice of cost flow assumption affect how goods are available for sale, are allocated to ending inventory and cost of goods sold. So we have doubled into this already, and practically that was why I used my own example. So you go through this also. If you have any questions, feel free to let me know. I think I don't see anything else we are to discuss. So those are the things you need to know. The driving point in our lectures today is for you to know that we have 3 turnover ratios, and we have 3 inventory methods to calculate cost of goods sold and ending inventory. And then you should know the implication of each of those methods, depending on the unit price of the raw materials or the goods that are in our focus. So those are the things you really need to know. And then you should know that the adjustment is done on income statement and the balance sheet. For the balance sheet, we expect to see the inventory, ending inventory or beginning inventory in the balance sheet. For the income statement, we expect to see the cost of goods sold. And management motivation of which method depends on what the management focus is. If they want to report more income, yes, shareholders will want to see more income. So what are the tax implications? If you report more income, yes, you have to pay more taxes. So in that case, at time management now look at different methods depending on what they want to do. If they want to report more income, yes, they look at the method that will give them that focus, that motivation. If they want, now they look at their tax implication, they also you look at which method would be better for them to focus on so that they will pay less taxes. No company wants to pay taxes more than is expected. So they will be looking at those methods depending on which method to use and to be motivated by their own motive, whatever should motivate them. If it is more income, yes, you have seen that depending on which method, average balance method is always in between. Whether it is rising, the unit cost is rising, or is falling. So you see that average cost method, if you try use different examples, you see that it will always be in the middle. So those are the things we have. Those are the implications we have for this course. Read through the notes very well. We will have, like I said, next week we'll continue with reading on reporting and interpreting property and plants and equipment. We'll be doing that next week. And then the first few minutes, maybe 10, 20, 30 minutes, we'll run through my possible quiz number 2 scenarios so that we discuss the quiz 2 next week before we continue the lectures. If there is any question, please ask now.
Professor?
Yes.
So regarding the assignment 4, which you uploaded earlier this week, so there are some requirement 2, requirement 3, requirement 4. There's no question to read, so I'm not really sure how to answer it. Can we go through a quick one?
What questions?
P07-03.
Let me see. Assignment, where did I put it? It's not there. Okay. I posted it in Excel, right?
Yeah, yes, correct, the Excel. But there's no question to requirement 2, 3, and 4.
Huh?
There is no question to requirement 2, 3, and 4.
Okay. For requirement 2, 3, and 4. Okay, let me check. I will check.
Same goes to P07-05. There's no question to requirement 2, 3, and 4 as well.
Okay.
And 07-06.
Okay, let me see. I'm trying to open my own Excel.
Okay. So for this assignment, do we need to complete all or just the first 2?
Look at the assignment and then try to, because most of them, they are links to each other. So you try to make sure you go through them. I want everybody to work on that. That is the only assignment I give, and I want us to do it in full, so that because that form the core and the foundation of the course.
Okay, understood.
I'm trying to look at it. Where is it? Why is it not showing in my this? It's not showing. I don't know where I put it. Wow. Well, I think my own, I don't know. I think my system is not opening up my assignments. I don't know what happened. But in any case, you have, I send you, I think it should be assignment worksheet on this chapter 7, right? He asks you to prepare income statement and you are given some numbers. It's just given and then what you are expected to complete. Am I correct?
Yes, for the table, we can still refer to the given data, but just the one with the empty blank, we're not sure what to actually type in.
So the first Excel sheet is what you have to fill out. And then the second is what is given to you to use to fill it out and then complete it.
Yes, correct. For the requirement 1, we have the question. It was given there. But just the requirement 2, 3, and 4, there's no question. It's just an empty blank. So we're not sure what we are supposed to do.
Empty blank?
Yeah, it's just an empty blank only for requirement 2, 3, and 4.
He's talking about the requirements. There are blank spaces or that say requirement 1, requirement 2, and 3.
But those blank spaces is not what you are told to complete.
Yes, but then if the blank statement they got mentioned like the average cost or the FIFO or the LIFO, yes, we can do it. But just you see, for the requirement 2 is to like just the totally blank. There's no any question to read, so we're not sure what are we supposed to put in or write in.
For blank question, what and what? Because I can't open my own, but I will open it later on. You said question what?
P07-03.
P07-03, correct?
Okay.
Okay, which one
requirement
again?
2, 3, and 4. Requirement 2, 3, and 4. There's no question.
That P07 to P03.
No, P07-03 is for requirement 2, 3, and 4. There's no question to read.
Okay.
I can share the screen. I can share my screen.
Yeah, Rodas, go ahead. You can share.
If it can help, okay.
Okay, let me see your screen because I don't know my own whether it's corrupted. I cannot open it, but that's okay.
Professor, I think you need to stop sharing so Rodas can share to us.
Okay.
Thank you.
All right. Okay. I can see it. Okay, this is 7.3. Okay. Given 0705 and then 06. Yeah, for any given that is what you should fill. Okay,
yes,
you're talking about 07 here. You are talking about 07.
Okay, we go to the first step, the P07-03. So basically for requirement 1, we have no issue because we know what we are supposed to do here.
Okay.
But if you refer to the below section, the requirement 2, 3, and 4, there's no questions to read or any table for us to refer. It's like just a total blank.
Okay, so for requirement 07, maybe that is why my system 2 is corrupt. So was it requirement 07-03? Okay.
Yes.
So you expect that there is no item to use to complete it. Is that what you mean?
Yeah, no item for requirement 2 until requirement 4.
Requirement 2 and requirement 4. But you have item for requirement 3?
Requirement 2 to 4 means 2, 3, and 4.
Oh, 2, 3, and 4. Okay.
Yes.
All right. Let me go through it. I will go to module and bring the assignment and see what I posted.
Okay.
Because
Same goes to
my own system is corrupt too. And then I will post it to. I will send you message. I will send all of you message on WhatsApp.
Professor, not just this tab only. We have another one also. Rodas, can you go to P07-05?
Huh?
Same goes to P07-05. There's no question to read also. Yes, this. For requirement 1, we can do.
What is P0? The next one that is given there, P0705, is
Yes,
the next tab. Use
yes,
the
it's
0.
Yes,
yeah,
the given one we can do for the requirement 1, but there's no question for requirement 2, 3, and 4 again. There's no question. It's just a blank, so we're not sure what to do. Okay,
what I want you to do is just complete that, leave the requirement section. Complete the items that are missing to form a, if it is income statement, to complete the income statement, you complete those items. Leave the requirement section. Let me go through it and see what happened.
Okay, I think the 07-03, 07-05, and 07-06 all have the similar issue.
Okay, leave that, fill in the blanks, and then leave the requirement section for me. Let me, I will either say you should ignore it, or I will give you more clue to that when I review the questions again.
Okay, thank you so much, Professor.
So let me just, I will note it down. I'll look through that.
Thank you, Rodas.
Okay, any other question? Okay, if there is no question, that will be all for today. You will receive WhatsApp if you need to complete those requirements. If you don't need to, I will still send WhatsApp and say, okay, ignore it or not. Okay?
Okay.
All right. See you next week. Review and start working on this assignment. And then when you come next week on Sunday, we'll work on some of my review questions on quiz number 2. So you take the quiz number 2, then we know we will have maybe one more assignment probably before we do the final exams. Okay?
Thank you, Professor. Have a nice day.
Have a nice day, all of you. Thank you and take care. You can always text me on WhatsApp. I'm always available. I will answer you almost immediately, as far as you are my student.
Thank you.
All right.
Have a nice
Bye-bye.
day.
And you too. All right. Bye.